According to a recent survey, nearly half of homebuyers don't shop around for the best mortgage rate. Don't make the same mistake. Watch our video to learn how to compare lenders and save money. If you're looking to understand what mortgage rates are and how they work, you've come to the right place. In this video, we'll break down the basics of mortgage rates, how they're determined, and how they can impact the cost of your home loan. First, let's define what a mortgage rate is. Your mortgage rate is the interest rate you'll pay to borrow money from a lender to buy your home. It's essentially the cost of borrowing money. Mortgage rates are influenced by larger economic conditions such as inflation, economic growth, and the Federal Reserve's monetary policy. They're also impacted by your own personal finances such as your credit score, debt-to-income ratio, and the size of your down payment. The cost of a mortgage will depend on the type of loan, the term, such as 30 years, and the interest rate that the lender charges. Mortgage rates can vary widely depending on the type of product and the qualifications of the applicant. To understand how mortgages work, it's important to know that they're loans that are used to buy homes and other types of real estate. Most traditional mortgages are fully amortizing, meaning that the regular payment amount will stay the same, but different proportions of principal versus interest will be paid over the life of the loan with each payment. Typical mortgage terms are for 30 or 15 years. When you apply for a mortgage, the lender will ask for evidence that you're capable of repaying the loan. This may include bank and investment statements, recent tax returns, and proof of current employment. The lender will generally run a credit check as well. If the application is approved, the lender will offer you a loan of up to a certain amount and at a particular interest rate. It's important to shop around for the best mortgage rate and terms. You can get a mortgage from a big bank, local credit union, or a specialized mortgage lender that only does home loans. There are also mortgage brokers that act as middlemen to help you find and compare lenders. You should compare a few different lenders and choose one that offers a combination of low rates, low fees, and good service. Now let's dive deeper into how mortgage rates are determined. Mortgage rates are set by the bond market, particularly the 10-year Treasury bond. When the bond market is strong, mortgage rates tend to go down. When the bond market is weak, mortgage rates tend to go up. The Federal Reserve also plays a role in determining mortgage rates. The Fed can influence short-term interest rates, which can impact mortgage rates. When the Fed raises interest rates, mortgage rates tend to go up. When the Fed lowers interest rates, mortgage rates tend to go down. Your personal finances also impact your mortgage rate. Lenders will look at your credit score, debt-to-income ratio, and the size of your down payment when determining your mortgage rate. If you have a high credit score, low debt-to-income ratio, and a large down payment, you may be able to secure a lower mortgage rate. It's important to note that mortgage rates can vary widely depending on the type of product and the qualifications of the applicant. For example, fixed-rate mortgages tend to have higher interest rates than adjustable-rate mortgages. Applicants with lower credit scores or higher debt-to-income ratios may also receive higher interest rates. Mortgage rates can have a significant impact on the cost of your home loan. Even a small difference in interest rates can add up to thousands of dollars over the life of your loan. For example, let's say you take out a $250,000 mortgage for 30 years at a 4% interest rate. Your monthly payment would be $1,193.54, and you would pay a total of $179,813.42 in interest over the life of the loan. But if you took out the same loan at a 3.5% interest rate, your monthly payment would be $1,122.61, and you would pay a total of $154,140.62 in interest over the life of the loan. That's a savings of over $25,000. Mortgage rates today. As of May 11 to 17, 2023, mortgage rates in the US are trending sideways, which is a welcome departure from the record increases of last year. The recent decreases in mortgage rates continues this trend, and the rate of growth in inflation is expected to decelerate over the remainder of 2023, which should bode well for the trajectory of mortgage rates over the long term. Rates in the next 5 years. According to a Bankrate expert poll, 50% of experts predict that mortgage rates will go up, while 17% predict that rates will go down, and 33% that rates will remain unchanged. The Federal Reserve has raised rates by 0.25%, and this is expected to push mortgage rates higher. However, the National Association of Realtors predicts that mortgage rates will drop, with the 30-year fixed mortgage rate progressively falling to 6% this year and to 5.6% in 2024. more. Experts predict that in the coming months, market conditions will affect the 30-year fixed-rate mortgage, and some say that mortgage interest rates may be at or near their peak, given recent encouraging news around inflation and a corresponding drop in the US Treasury yields that help set mortgage rates. The Mortgage Bankers Association (MBA) says that long-term rates have already peaked and that 30-year mortgage rates will end 2023 at 5.2%. While predicting mortgage rates for the next 5 years is challenging, experts say that the low housing inventory will be a key factor in where rates go over the long term. Despite this, rates will eventually come back down, but the timeline for this downward trend remains uncertain. Buyers should expect a rate volatility as a result of the fight over raising the debt ceiling, which is likely to drag into the summer. Mortgage rates are directly impacted by the bond market, and the rate offered on a mortgage will depend on the lender you work with, its business costs, and your financial profile. Demand for mortgages can also affect rates, pushing them higher as available capital for lending tightens. It is recommended to keep an eye on rates, check your credit, and shop around and compare lenders to find the best deal for you. How to compare lenders and save money. When comparing lenders to save money on mortgages in the US, there are several factors to consider. To begin, research different mortgage lenders and their offerings. This can be done through online resources such as lender websites and third-party comparison sites, as well as by speaking with loan officers at various financial institutions. Next, compare interest rates and loan terms offered by each lender. The interest rate is a crucial factor as it determines the overall cost of the mortgage. Look for the lowest possible rate, but also consider the loan term, which can impact the monthly payment and the total amount paid over the life of the loan. Additionally, consider the types of loans available, such as fixed rate, adjustable rate, and government-backed loans. Each loan type has its advantages and disadvantages, so it's essential to understand which one best suits your financial situation and long-term goals. Examine the fees and closing costs associated with each lender. These costs can vary significantly between lenders and can add up quickly. Some common fees include loan origination fees, appraisal fees, and title insurance fees. Make sure to account for these costs when comparing lenders. Furthermore, assess the lender's reputation and customer service. Read online reviews and ask for recommendations from friends and family members who have recently obtained mortgages. A lender with a strong reputation and excellent customer service can make the mortgage process smoother and less stressful. Lastly, consider the lender's flexibility and willingness to work with you. Some lenders may offer more flexible loan terms, such as allowing for a lower down payment or providing assistance with closing costs. Others may be more willing to work with borrowers who have less than perfect credit or unique financial situations. In conclusion, mortgage rates are the interest rates you'll pay to borrow money to buy your home. They're influenced by larger economic conditions and your own personal finances. Mortgage rates are determined by the bond market, particularly the 10-year Treasury bond, as well as the Federal Reserve and your personal finance situation. It's important to shop around for the best mortgage rate and terms, as even a small difference in interest rates can add up to thousands of dollars over the life of your loan.